Hello? Okay. Hold this. Assalamualaikum. So, I'm Saarah. I'm from Delhi University, and I'm a bachelor's in computational finance, currently working as a quantitative analyst. So today I'm going to be talking about artificial intelligence in financial trading. So people are very much interested in putting AI to use in financial capital markets, and it's relatively new and it's pretty hard to do that as well. So I'm going to just give an overview. Sorry. So yeah, so I'm just going to give you an overview of how financial trading can be done, what are the techniques that we use, and how we can put in AI into space and work things out. So, okay. So the financial trading, if I give you a bit of background, because I'm not sure about how much everybody knows here, so I'm going to keep it very basic. So financial trading is basically the art of selling and buying different securities. Mostly people are concerned with capital markets as in stock markets, in equity tradings and stuff. So they're like buying and selling securities or like that. So a rational investor's expectation is to mainly gain more profit on their return, on their investments initially, and are able to avoid as much risk as possible. So, a rational investor is basically risk averse. This term basically means that they're not going to take on more risk than possible. So the thing about financial trading is that people are not really sure about how to put an AI into this, because the whole idea about financial markets and their data is the fact that it's too noisy. So it's not easy to like go about it and just tell the AI, okay, this is the data, and put it into the model, and then we can make prediction, because it gets harder for the AI model to basically distinguish between the signal and noise, because there's a lot of noise in the data. So how do you make sure that how do you actually use AI into this? People, the methods that they basically adopt to analyze the companies in which to invest in are basically three. There is fundamental analysis, technical analysis, and there's another one, a quantitative analysis, right? So based on the duration of trading, as in you want to go long term or short term, as in the duration of your investment, as in you want to invest for shorter periods or longer periods, and how frequently you want to trade, you can decide what strategy suits you the best. So the types of analysis is, first off, you go for technical analysis. It basically relies mostly on data. So होता इसमें ये है कि जो historical data होता है आपके पास, उसपे you apply some certain signals. So there are like averages, moving averages, RSI, and a couple of others. What they basically do is at the intersection of these signals, you understand buy and sell signals. As in, if there's for instance, there's a moving average. Moving average for 20 days, what it does is basically an average across the prices, previous 20 days prices. ठीक है, एक 20 day का average हो गया और एक for instance 100 days का average हो गया. So in the crossovers, people basically buy and sell. That is something basically a trade bot is capable of doing. That's called automated trading. So they rely on technical analysis. It solely depends on historical prices, and the expectation of profit is usually through capital appreciation. Capital appreciation is basically changing in price. And they mitigate risk, and they avoid risk that comes up here by offsetting investments, as in investing in short selling along, taking long and short positions. That basically means buying or short selling. Whereas one more thing I would like to add here is in technical analysis, people basically go for like short-term investment. Since you're basically trading on higher frequencies on daily basis or intraday trading, so you usually go for short-term trading, so you rely on historical data and the short-term trends. Whereas when we're talking about fundamental analysis, what basically happens here is you're going for long-term investments. So you go through company's financial history, there you look at their fundamental data, you look at things, how the company is basically performing and their potential to do better in the future. And on the basis of ratios, which I believe you guys are aware of how that works, accounting standard, certain accounting ratios and their financial statements, you're able to analyze how well a company is going to be doing in the long term, whether you want to invest well growth, and your source of income through that kind of investment is basically through capital appreciation, as in the changes in prices, as well as the dividends and stuff that companies pay out. Again, risk, how you avoid risk over here is through diversification. I keep saying on risk. So here's the thing about things that investors are basically concerned with are risk and return. Before 2008 crisis, people were more interested in doubling their investment or gaining as much profit on their investment as possible. But since after that, things sort of changed. People are now more inclined towards preserving their principal investment. What does that mean? They're not willing to take on more risk than they can handle. Since after that crisis, risk has been in the eyes of many companies, many giants, financial giants, and money managers, and they want to model the risk. So the question is, how do you really model that risk? So here's a thing called quantitative analysis. It relies very heavily on mathematical computations and equations, calculus, and a lot more boring stuff, but trust me, it gets really amazing. So what happens is, through quantitative analysis, through mathematical models, you're able to understand the movements, not just the movements of prices through the historical data, but also incorporate into them fundamental data and see how that works out for you. They may look scary at first because they are very complex and well scripted and whatnot and all the calculus and stuff. But they do a pretty good job at estimating or predicting your risk and analyzing what are potential areas where you can invest and do things. The best thing about it is that you're able to basically quantify the risk. Okay. So previously I was talking about algorithmic trading. Let's have a look at how we can make one of those signals. The thing about making those signals is you can use them and basically algorithmic trading hota hai hai ki you use a trade bot. What a trade bot basically does is you tell them, okay, if this particular signal crosses this line or if the prices go above this particular condition or criteria, then you should trade. The trade bot is basically able to do that. How you build up that trade bot is basically you need to know certain programming languages and you're able to put things together and it does that for you. So you don't have to sit in front of a trading screen all the time and get done for you. That's one potential area where you can put AI into use. Currently, it's not that diverse, and what a trade bot basically does is it just looks at what the prices are and whether or not it meets the criteria. If it does, it's going to trade it. If it doesn't, it's not going to do anything. So simple moving average is one of the very simplest things. It computes averages across a very small period, as it define it. Say X periods, there's like X and Y. So simple moving average of X periods and simple moving average of Y periods. And at the intersection of these, the trade bot basically executes trade. So I was wondering, where does AI basically even come into place? There are things that are pretty static, so how can you put AI to use here? Through AI, you can make your trade bots more sufficiently intelligent enough to understand how we cannot entirely rely on just historical prices and incorporate these two fundamental and technical analysis techniques into a single platform and be able to, gauge the performance of your algorithm through that. Because solely relying on a single technique is not sufficient. The reason for so is basically there's a concept in finance that the random walk theory. There are people who believe in that and there are people who don't. Random walk theory, what it really tells you is that on the basis of historical data, you cannot predict the future. Whereas there are people who say that history repeats itself. So on these two contrary school of thoughts, the thing is, if you believe that historical prices are enough, you basically go for technical analysis. If you think they're not enough, you go for fundamental analysis. People who are value investors or growth investors, like Warren Buffett, you probably have heard of him. They usually go for fundamental analysis. They go for the performance of the company and their potential. Whereas technical analysis is sort of tricky. Sometimes the trends do repeat themselves. Sometimes the trends are there. Sometimes they're not. But still a tricky job. So how can you put AI into use over here? People, when they're going for fundamental analysis, they're unable to get enough data because obviously it's all about data. If you don't have enough data, how do you really put things to use, right? So the thing about fundamental data is you're using financial reports and financial statements that are issued on a quarterly basis. So if you're looking at a company that's been in the industry for about 20 years, you've got, 80 data points because they've only published 4 reports for a year, and that would be like 80 reports in like 20 years, right? So how do you use that, just 80 points, to make a sustainable model that does well on fundamental analysis? So mostly people opt for like technical data or historical pricing to try to predict those things. So the thing is, there are some research papers. If you've heard about Farmer and French model or multi-factor models and models like these, what they basically do, they use a proxy for a particular fundamental factors and observe those factors and observe the return of those companies in relation to those factors. So what happens is they're able to identify certain parameters. For instance, say a proxy for value or the worth of a company, they use the book to market ratio, right? So they observe the returns or the spread of companies that fall at the top of value book to market ratio and the bottom of the book to market ratio that would make up value and growth company and how much the spread is there. So on the basis of those spread in their return, they're able to determine how much return is there and whether or not you can use this technique to hedge against them or not. So initially, although their model is a risk model and what they do with it is usually for long-term investment, for longer horizons, but that is something you can incorporate and use because the equation looks pretty much like a regression equation. So you can use that to get to some more viable results. So the problem let's go about our success story. There's a company called Caveout, I don't know how to pronounce it, so yeah. It's basically based off in US, and what it does is uses the power of AI and quantitative analysis to offer 3 of their products. A product will get Smart Advisor. It tells you where to invest. As in, Irfan previously discussed about their Rasheed stage, I believe, which used to ask questions from the people and tell you how, put the accounting stage in perspective. What this basically does, Smart Advisor, it asks questions, कि आप कहाँ पर invest करना है. It basically builds your risk profile. So what a risk profile basically is, it's going to ask you what your age is, आप कितना कमाते हो, आपकी क्या खर्चे हैं, and on the basis of that, वो आपको बताएगा कि आप कहाँ कौन सी कंपनीज के अंदर investment करनी चाहिए. What it's basically doing is matching your risk profile against the potential companies and how much risk they usually offer, and it builds a portfolio around that. Another one of their products is AI powered charts. It charts out different indicators and many indicators out there. Basically charts out their performance in it, and it helps you understand better, mainly for people who are not from financial background, कि AI में finance basically movement किस तरह हो रही है, या फिर markets या companies movement किस तरह हो रही है, whether or not they're good enough for you to be investing in them or not. So here's a comparison of some AI managed funds and non-AI managed funds, which initially our guest speaker did share. So there's just numbers. So as you can see, that AI managed hedge funds ने काफी बेहतर perform किया as compared to non-AI managed funds. You can see at the top, they're like 40% return in 2011 as compared to negative 1.7%. And moreover, around the latest year, 2016, 5% return as opposed to 4.48. So there are AI managed money funds that are doing much more better than normally managed people, because one thing, it eliminates biasness. So when it eliminates biasness, and money managers who are trying to sell you companies, stocks of companies or instruments that they're in touch with, or people they're in touch with. So it usually eliminates that kind of biasness and gives you a more better and more appropriate picture. There's another company that's based off, they have basically Indian co-founders. What they basically do is they offer one is a personal chatbot advisor that is very similar to the smart advisor I mentioned before. ये basically कहते हैं कि आपकी risk profile को develop करता है on the basis of which you answer to it, as in your demographic details or your personal or expenses details, and tells you where to invest. It also helps you trade algorithmically. Algorithmic trading is basically a fancy word for it. It basically does just see the intersection of which indicators should you be buying or selling, when should you buy, when should you sell. And it's obviously local and there's a ton of modern quants. So what exactly are quants? A quant is...
Sorry, Saarah, we have 2 minutes left.
Yeah, cool. So I'm going to wind up pretty soon. So I'm just going to go over quants. Quantitative analysts or quants are basically people who are really good at mathematics, statistics, programming as well, and finance, and they're able to put all of these things together and using it for investment purposes. So a modern quant is somebody who's equipped with all the data science techniques and is able to put them to use and make more intelligent and data-driven decisions regarding financial investments. So these are potential areas of investment where you can construct a portfolio. When you're talking about construction and selection, it's basically concerned with which companies to select in your portfolio, which companies to invest in, because that is सबसे बड़ा सवाल लोगों का ये होता है कि हम लोग आगे गए हमारे पास पैसा है हम लोग कहाँ पर इन्वेस्ट करें. So if you want to know where to invest, how to invest, AI can basically help you do that. So regarding portfolio construction and portfolio selection, you can use AI, you can use fundamental techniques, you can use technical techniques to go about and select which companies work best. There's risk analysis, which is pretty much a big hype in financial sector and how they go about it. So you can quantify risk better, because the whole idea is it's not getting the best returns anymore since the advent of derivatives and since the advent of more complex securities and instruments, the market has been pretty volatile. And if it's volatile, then if you go into the market, you really want to know that your initial investment stays intact. You don't lose that. So to make sure that happens, that risk analysis has gained hype. So go towards quantifying risk, go towards understanding risk. Don't go for like, I'm going to double your money or something like that. That's pretty attractive to most people and people lose money in that. But like, go for risk analysis. The reason for so is like, at this moment you're prepared and you understand on the basis of what reasons your returns vary. Because something that's really fascinating is return variations and how returns vary over. So how returns basically vary. Say a company has returns, you see their fancy charts like. Okay, so you've seen fancy charts that go like spikies and stuff. So what you can do basically with it is spikes go up, but they're pretty volatile. It's not really good enough for you to understand, and good enough for algorithms to basically understand. So the understanding of risk is basically knowing that अगर कोई company stock market बिल्कुल नीचे जाएगी, so I'm prepared to take that hit, and I'm not really going to lose all of my investments. So I'm just going to go over the skills that I previously mentioned. You guys need to dig into mathematics, linear algebra, and all of these things, because they are pretty much going to help you in understanding how finances really work. The thing is, most people who are not from finances are interested in predicting stock markets. So the idea over here is do understand how markets work and do get into mathematics, and they'll really help you. So yeah, that's about it.